Okay, I'm going to do some problems out of the back of Chapter 4, and this will be the last information needed in order to be able to complete the midterm problem. So this is what happens when we have non-controlling interests. So we did not buy 100% of the outstanding common stock. So we'll start with number 37. And in this one, Paloma Company on January 1, 2017 exchanged $1,710,000 in cash for 90% of the outstanding voting stock of San Marco Company. The consideration transferred by Paloma provided a reasonable basis for assessing the total fair value of San Marco. At the acquisition, the San Marco owner's equity had common stock of $400,000, additional paid-in capital of $60,000, and retained earnings of $265,000. They had a customer base with a assessed fair value of $800,000 that was not reflected in the books. And so that is going to be with a 10-year remaining life. And then so the problem goes on. This is all on page 202. Problem goes on to give you the calculation for goodwill, which is $375. So it is now the end of December 31st, 2018, and we're given here the trial balance, the income statement, statement of retained earnings, and the balance sheet for both Paloma and San Marco. Okay? So, the S entries. The S entry is common stock, the additional paid-in capital, so that's $400 in common stock and $60,000 in additional paid-in capital. And then beginning retained earnings. So you always use the beginning retained earnings, which in this case is $395. All right, so this is where it differs. The A entry is going to be split between two areas. The S entry. The S entry credits are going to be split. There's going to be an entry in the investment account, and then there's also going to be an entry down here in this non-controlling interest in San Marco. So what this is we're going to take the sum of those three, the retained earnings, the common stock, and the additional paid-in capital, and we're going to multiply it by the interest, which is 90%. And that's going to give us $769,500 for the credit to the investment account, because that's our pro rata share. Go ahead and copy that formula from the formula bar to the clipboard, and then come down here to the S entry for the non-controlling interest. Paste that formula from above and then change that to 1%. And $85,500 is the 10% ownership that the non-controlling interest have. The A entry is going to consist of the calculation of goodwill, which was given to us in the problem at $375. And then the customer base. And the customer base initially was $800,000 with a 10-year life. And 1 year of that 10-year life has gone away. So we have the $800,000 minus the $80,000 per year amortization. So we're going to do the same thing with the credits for the A entries. We're going to split them between the investment account. So we're going to go equals again, open parentheses. We're going to add the customer and the customer base and the, actually, I'll fix that here in a second. Let's just fix it now. I had that in the wrong row. I had it in buildings. Okay, once again, the customer base plus the goodwill times 90%. Copy that to the clipboard. Go down to the cell where the non-controlling interest in, paste it in, change it to 1%. And we have 109,500 and 985,500. Okay, the sum of those two, and these are both credits, so make them negative. The sum of those two credits is going to go into the non-controlling interest column. So that's the S and the A. The D entry is going to be the same, only just like the S and the A entry, we're going to split that because we didn't get 100% of the dividends. So this is going to be F23 times 90%. And then the remaining F23 times 10% goes into the non-controlling interest column. So that's the S in the A entry and the D entry. The I entry is the same as what we did before. So the I entry is removing, which is 121,500, removing the I. Oh, hold on. We needed a D entry here. And the I entry. And that zeroes out the investment account. And then the last thing is the E entry, where we have under amortization expense, we have the 80,000, and the offset to that is the customer base. And I'll change that. This was the I entry, not the E entry. And 80,000. That's the SADI entries. The last thing you need to do is you need to attribute consolidated net income to the non-controlling interest here. And what that is going to be is the income from the subsidiary, which is in cell F16, minus the amortization. Now, keep in mind that the value in F16 is a negative number. We need to reduce that. So to reduce it, you're going to add the adjustment for the amortization and then multiply that times 1%. So does that make sense? This is a negative number here, this 215. If you subtract the 80,000, you're going to be increasing the separate company net income, not decreasing it. We want to decrease it. We want to take it from the 215 down to 135. So to do that, you have to add the 80,000, not subtract it. And at that point, the sum of this column, non-controlling interest, the $13,500 in separate non-controlling interest income, the the $2,500 in dividends that were given to the non-controlling interest, and the non-controlling their share of the S&A entry. That adds up to $265. That comes over as a separate reported credit in the stockholders' equity section of the balance sheet. All right, so that's it for problem number 37. Okay, the next problem I'm going to do begins on page 203. It's problem number 39. Padre Inc. buys 80% of the outstanding company common stock of Sierra Corporation on January 1, 2018 for $802,720 in cash. At the acquisition date, the total fair value, including non-controlling interest, was assessed at $1,003,400, although their book value was only $690. There were several individual items identified that had fair values different than book values. So the acquisition fair value is given to us at $103,400. We had $690,000 in book value, giving us an excess over book value of $314,000. We had land that had a fair value of $290 with a book value of $65. We had buildings and equipment with a fair value of $263 and a $287 book value. We had copyrights with a fair value of $216, fair book value of $122. And then lastly, we had a note payable with a book value of $157,600, a fair value of $157,600, and a book value of $176. Actually, flip that around because the fair value is lower than the book value. There we go. And that equals exactly the $313,400 that we paid, giving us 0 in goodwill. And then down below, the chart was automatically populated. The building had excess amortization, remaining 10-year life, copyright 20, note payable 8. So there's our various amounts for that. All right, go down to the accountant's worksheet, and we start with the S entry. The S entry has common stock and additional paid-in capital. And by the way, it is now December 31st, 2018. So we bought it on January 1, on December 31st, 2016. So 2 years have gone by. 1 year has gone by. 17 has gone by, and we're currently in 18. So we have 1 year of prior amortization to take into account for. So $100,000 in common stock, $60,000 in additional paid-in capital, in beginning retained earnings. Always remember to use beginning retained earnings of $530. So the investment in Sierra, the credit, is going to be the retained earnings plus common stock plus additional paid-in capital times 80%. And then we're going to copy that formula to the clipboard and then go down to the non-controlling interest and do the other half of the credit, changing that from 80% down to 20%. The A entry is the land at 225. The building and equipment is going to be a credit, and this is where the prior year amortization comes into effect. It was originally $24,000. And let me see here. Oh, Padre, this is all the same year. So 2018 to the end of 2018. So it is the full 24,000. The copyright of 94,000. And then lastly, the reduction in the liability for the note payable, which is going to be a debit of 18,400. So the A credit up in the investment account is going to be the land minus the building plus the copyright and plus the note payable, all times 80%. Copy that down. Go down to here to the non-controlling interest. Paste that in, change it to 20%. And the column for non-controlling interest is going to be the sum of those two as a negative number because they're both credits. The D entry is F129 times 80%. And then F129 times 20%. And then the D entry here, the offsetting debit. Alright, that leaves us the I entry, and the I entry is the full amount that was recognized at the parents' books for their pro rata share of the income. And that is going to be a credit to the investment account, and that zeroes out, once again, the investment account. The E entry is a reduction in depreciation expense for the 2,400 in building. That's the 24,000 at a 10-year life. We have an increase in amortization for the copyright, and that was 94,000 on a 20-year life, or 4,700, And then we have an increase in interest expense for the 18,000 over an 8-year life. So that is 2,300. And the offsets to that is the building gets the 2,400. The copyright gets the 4,700, and the note payable gets the 2,300. And then the last thing is the interest income. So the interest income is going to be the income from the subsidiary, which is in cell 121, F121, minus the depreciation plus the amortization plus the interest times 80%. I'm sorry, times 20%. And then the sum of that is 131,960, which becomes the non-controlling interest in Sierra, and everything is correct.